In today's video, we're chatting mortgages, the difference between fixed rate versus variable rate mortgage, help you understand which one is more suitable for you. We will go over the difference between A lender and B lender, and then we will answer your most common questions asked over the past month's time. And to make sure that we have all the accurate answers, we are bringing on one of Toronto's top mortgage brokers who's bringing a bundle of knowledge with him. So let's dive right into it. Naman, thank you so much for joining us, buddy.
Thank you so much for having me. It's not every day where I get the pleasure to have a great conversation with you.
Yikes, dude! For how handsome you are, I'm surprised you're doing mortgages and not doing modeling. So tell us a little bit about yourself, buddy. What is it that you do for a living?
Always. Yeah. So I'm actually the founder of 𝐼𝐻𝐻 Wealth. So we're actually powered by Mortgage Intelligence. So we've been in the mortgage industry for about 6 years now, actually 2023, 6 years. But I've actually been a mortgage broker for the last 2 years. So I come from a background of being a private lender, and then I switched in so I can do the process from end to end. But now I'm not limited to just private lending. So we deal with all A lenders, for normal deals. We have B lenders for, self-employed, high-ratioed deals, people who are not able to qualify with the A lenders. And now we also still continue to deal with the private end as well. So yeah, here to help in terms of all your mortgage needs, whether it be the refinances, first-time home buyers, investors looking to kind of structure their deals or their closings in the upcoming years. So yeah, for mortgages end to end, here we are.
Lovely. So we're going to come back to the difference between A level and B level financing. To us, that's a very common term that we use throughout our days. But to the average consumer, they have no idea what the difference is between A and B and the pros and cons of it, right? But first, I want to talk to you about a question that comes up every single day. And it's been coming up since we've been having all these rate hikes. And right now, people just don't know kind of what to do, right? So talk to me about what a fixed rate mortgage is, and what a variable rate mortgage is, and then I'll give you a follow-up question right after that.
So the main difference between the two are kind of goes by the name. So a variable mortgage basically goes by whatever prime rate is, whatever, and the discount that's applied on a mortgage. So typically you'll hear in a contract rate, it'll be prime minus 0.25. So that means from 6.7, you take out 0.25, and then there you go. That is the interest rate you're paying. And as prime fluctuates, so does your interest rate on that mortgage. So depending on the bank, this could be adjusted monthly, quarterly, semi-annually, right? Really does depend on the lender themselves. And exiting a mortgage like that becomes quite straightforward. It's only 3 months of interest-only payments. So in a 2-year term, 3-year term, 5-year term, whatever the term may be, anytime you want to exit, 3 months of interest-only payments, and boom, you're out to the next product or the next property. Whatever that may be. For the fixed, it sounds exactly what the name is. Let's say today, as fixed rates are creeping to go down, let's say if you get let's say you get a fixed rate at 4.99%. Now you're stuck paying that 4.99% regardless of how prime is actually fluctuating. Fixed rates are dependent on bond yields. So if you're getting a 5-year fixed, it depends on the 5-year bond rate. If you're getting a 3-year, then it depends on the 3-year bond rate. So that's what the comparison is when they come up with the fixed values. And exiting those mortgages is typically a bit more pricier. They look at the interest difference. So if I want to exit at year 2 of my mortgage, okay, well, what is the fixed rate for that same product today versus what you actually locked it in as? They look at the difference, they multiply by the years that you have pending, and then divide it by the months. It's like a whole equation. And that is typically the penalty that you pay to exit. Typically, it will obviously be greater than 3 months of interest-only payments that you have.
Sure. So just to summarize that, usually on a fixed rate, of course, it's a case-by-case study. If you wanted to leave that mortgage, let's say you're selling a home or you're downsizing, the penalty on a fixed rate is usually higher than a variable rate mortgage, correct?
That is absolutely right.
Okay, so let's dive a little bit deeper into this. A lot of the folks that are watching our content today are first-time homebuyers. And first-time home buying is always hard for youngsters, but we want to encourage them because it only gets easier. Getting your foot in the door is hard, but then it builds your portfolio and it grows from there, right? For someone who wants to buy a home for, let's say, $700,000, do you recommend they go with the fixed rate mortgage, or do you recommend they go with the variable rate mortgage?
Yeah. So if you asked me this question maybe 4 months ago, 6 months ago, it'd probably be a very straightforward answer. It would be variable. Even though variable rates were going up, I would still choose variable. Reason for that is with any type of investment, you always have to look at your entry strategy and you have to look at your exit strategy, no matter what that circumstance may be. So looking at that overall kind of proposition, a variable would always be the best idea. But here's the trick now. As of last year, even fixed rates were at its peak. At the beginning of this year, fixed rates have started going down. And that is indicative of where the market is headed in the next, like I said, 3 years, 5 years, whatever bond yield you want to compare this with. At the end of the day, you have to look at what is the best product for you today and what do you qualify for more, right? So the way the stress test works, it is whatever the contract rate is, meaning the rate that you're actually paying, plus 2%, or it is 5.25%, whatever is the greater of the two values. Obviously, you're not going to be stress testing at 5.25. Rates, whether it be fixed or variable, they're much higher than that. So that's out the door. If you look at a variable rate right now, let's just assume that you're paying prime, okay, which is 6.7%. That first-time home buyer now is being qualified on 8.7%, right? 2% higher than whatever that rate is. Versus, let's say if you go for a 3-year fixed or a 5-year fixed, which 5-year fixed I'm not even recommending because I think rates are going to go much, much lower. So let's just say for qualification purposes, you do 3-year fixed. 3-year fixed, again, let's just say it's mid-4. So it's a 4.7, 4.8. Now that same client is now being stress tested at 6.8 because it's 2% higher than that. So now the battle you have to make here, or the fight you have to have internally is, do I go for where I qualify the most, knowing the fact it is fixed and interest rates may fall? Or do I say, hey, listen, I qualify with the higher qualification rate, and I know the fact that I will slowly be paying less monthly payments as the rates come down. So the reality is, what do I qualify most for? And is this the right product for me? That is ultimately the question. It's not as easy. It's not as simple as anymore as, oh, here's a variable and here's a fixed. Go for the cheapest rate.
And it never has been that easy. It's always been a case-by-case study. So let's presume that the same family is going to be moving into their first home, and in their mindset, they're there for at least 5 years. At that point, what is the 3-year fix right now and the 5-year fix? What is variable right now? And based off of that situation, what would you advise to them?
Yeah. So I actually pulled up my handy dandy spreadsheet, which updates every single day. So when it comes to insured deals, so typically, I mean, I'm not sure if you want to jump into insured versus conventional, because typically first-time home buyers, they most likely will not have the 20% ready to go. So in those circumstances, you have an insured product. So in that case, ideally, if you go for a 3 or 5-year, the numbers could range anywhere from 4.8, let's say 4.6, 4.7 for an insured 3-year. And then if you want to go for a 5-year, and if you want to go for a 3-year, which is a bit shorter, it would be around 4.8, 4.9%. And these are fixed, right? Respectively, 5-year and 3-year. If you want to go for conventional for insured, typically it is prime, which is 6.9 minus 0.90. So essentially you'd be paying around 5.8% if you went with a variable. And again, that doesn't really matter whether you go for a 3-year or a 5-year. This discount amount is always applied on the prime, so that fluctuates.